Bridging loans have become an incredibly popular way to raise finance. So I thought today I'll tell you a little bit more about how they work. Bridging loans are a quick way to raise finance short term on a secured basis. You will often find that you are dealing with a transaction and urgently the structure of that may well change. You may well have already agreed some form of traditional finance, but the timescales for that to come through may well mean that the opportunity in front of you could be missed. That opportunity could be that you are buying another property, you're buying a business, you've got a tax bill you need to pay, or potentially working capital, maybe some new contracts that you've secured, and just the time frame of being able to wait for traditional finance or even selling maybe one of your own assets is just going to take too long. So how does a bridging loan work? Well, bridging loans are secured against property assets. Typically speaking, you can get a bridging loan that is either a first charge or a second charge, and the property asset could be a residential buy-to-let, it could be a commercial property, it could even be your home. A first charge bridging loan will enable you to generate far more cash by the way of the loan to values that are typically worked on with bridging loans. Second charges are fine, there are less lenders that will do those, but of course they have to take into consideration your first mortgage and so may not be able to free up enough money. How do they work? You will typically be able to get a bridging loan for somewhere between 12 to 24 months. You have options with regards to the monthly interest. Most bridging loan lenders would like the interest rolled up so that therefore you will pay it back at the end of the term. Some will allow you to pay it on a monthly basis, and others will happily do a split. The bridging loan can be repaid early, so you will only typically pay interest for the period it's outstanding, albeit that there will be some lenders that will have a minimum term, which may be 3 months of interest that you have to pay, even if you paid the bridging loan back early. Repayment. This is really key for any bridging loan lender. They need to be really certain about how you're going to pay the money back. So that may be a property that you are already selling, could be another property. It could be from a refinance, as we talked about earlier with traditional finance that you are arranging, but it is important that there is a clear exit strategy. Otherwise, the property that you have put up as security is clearly at risk. If you would like to know any more about bridging loans, then please feel free to contact any member of the MHA Banking and Finance team.